You are watching the Stacks Podcast, the show for crypto investors. Today I'm joined by Jordy Alexander, game theorist and chief investment officer over at Selene Capital. Dude, our last conversation was one of my most downloaded episodes I've ever done. It's nice to have you back, dude. I'm excited for this.
Good to be back. Yeah. I mean, it was only like a few months ago, but it feels like a different world, kind of being pre-Celsius and 3 AC.
Yeah, when you said it was only 2 months ago, I was like, no, there's no way. Three Arrows Capital, all the selling that we covered that, right? And no, that's all happened within the past 60 days.
Yeah, I feel like I've aged like a few years already.
The prices were, as we were talking about before the show, I mean, things were bad. They weren't this bad, though. And a lot of what we talked about during the call was kind of a game theory approach or what's the optimal strategy for investors in a bear market, right? There's different games you play. You're going to be less active probably with altcoins. You're not seeing as much upside. You have to adjust a little bit. In my head, when we recorded that, I was like, oh, next time we talk, we're going to be able to be in a bull market and we can kind of grade what we talked about and say, that was a good idea. Maybe we're a little off base there, whatever. But we're kind of in the same spot. To put it bluntly, you said the economy is fucked. This was one of your threads yesterday. Can you expand a little bit before we talk about, because we're going to talk about ETH in this episode. You just released some new analysis there. It's going to challenge some ideas people have, but to just give like a bird's eye view of what's going on, maybe why things aren't so pretty here yet in crypto again. Why is the economy fucked? What's going on here?
Yeah, I mean, first of all, in terms of that colorful language, I usually edit my post before I send tweet all. And I wrote this whole thing. It's like, 10 to 12 tweets. And before checking it, I sent it out and I saw the word fucked. I was like, okay, whatever. Let's just go with it at this point. Doesn't matter. The economy is fucked because the assets that have inflated so much over the last few years cannot be allowed to inflate any longer. So at all costs, the Fed is going to have to put a lid on asset prices because asset holders have done way too well compared to people who are just facing the downside of it all, which is inflation. So what I foresee over like the next year or 2 years is really, instead of having like a Fed that's going to support the economy and support asset prices, it's going to kind of be the reverse. They're going to try to slow things down, try to drain things out of, liquidity wise, especially. And, going through a lot of thought experiments of, who's going to be suffering the most, because what usually happens in democracy is the squeaky wheel gets the grease. And in this case, I see that, people who are not going to be able to pay their gas bills or their energy bills in Europe, especially, or people who will have a hard time putting food on the table are really going to be demanding a lot of changes. And so people who are expecting a Fed pivot into like what we've already been used to for the last decade might be disappointed. And in fact, it could get quite a lot worse in certain countries. Maybe not the US, but definitely in other countries.
Just in my totally macro LARP, I'm not an economist. I understand enough to be dangerous, but I know enough to also know that I barely know anything about macro and how it impacts some markets. I've looked at, the last inflation numbers. I think they came out and they were lower month over month. I think year over year inflation, it looks like has peaked. That we at least have a local top. I'm not saying it's peaked for good, but when you see macro data coming out like that, it's not good yet. We don't have low inflation. Inflation is still pretty ridiculous year over year. But like, let's say inflation has peaked, just to push back on that idea. Is it not a smart thing to think, well, if it's peaked, then maybe the worst is behind us? It's still not good, but the rate of change isn't getting worse. And that means that maybe we've priced in maximum pain. Is that kind of not the smart view to have, just because, look, things are going to get worse and this is a big change from what we're so used to for the past 10 years?
Yeah, I mean, in terms of getting month-on-month inflation to slow down, this was always something that was going to happen. It's just not sustainable to have 1% and 2% month-on-month rises in inflation. However, I kind of like my mental model is you have like an anaconda, and the bigger the meal it eats, like if it eats like an antelope, which is like 9-10% inflation, even if it doesn't eat anything else, it really takes a while to digest it. Like it's going to take a slow, period. So people who are facing 10% inflation on their daily costs and their wages have not gone up by the same amount, they will not be able to kind of stomach it, even if they don't change. Like even if the prices stay the same, they're kind of hoping that they go back down. Otherwise, they're eating into savings, and at some point, savings run out. So, right now we haven't seen the full effects of this because households in general do have some savings and corporations have money on their balance sheet, but that will start getting eaten up. And in terms of like the getting used to like numbers like 8 and 9% I mean, it's supposed to be 2%. So we're so far away from that even if we get to like 5%, it's not that they can just slow down and go back to business as normal. They really have to go all the way back down to 2% at some point. And so I think the inflationist peak narrative was very misplaced. And this kind of bear market rally that we saw, that's actually like ending in the last few days, and we're kind of seeing a bit of a correction, I think was totally misplaced, and we do have some pain ahead.
Like, what's the optimal approach then for the average investor outside of crypto? As the Fed is now kind of punishing the people they were just supporting, probably too much in the past couple of years, especially after Corona. Like, some of these assets are going to round trip. Like, stocks, are almost actually already back at highs, but crypto took a big hit. Stocks definitely took a big hit. Should people be out of those and just be looking at hard assets? Like, what's the right approach? Because now you can't be in cash. Risk assets are probably still going to get hurt. What are people supposed to do?
Yeah, this is definitely an environment that's more suited towards active investors and people who can do relative value trades and that type of thing. It's quite a hard environment for people who just put passive index funds and do like very passive investing. It is quite difficult. I would say like they should position quite defensively in that situation. Like, yeah, definitely hard assets, like real assets to a certain extent. In terms of currencies, that's a tricky one. If you're living in the United States, I think you've seen quite a strong dollar recently, and it's probably going to stay that way for a little bit more, at least like the next several months. I think if you're in other countries, like in Europe especially, there is a little bit of a crisis going on. I think it's not necessarily a time to try to make a lot of money. It might be a time to position yourself defensively. So if you're in a certain country, maybe just think about like what your expenses are going to be going forward, which currency they're going to be in, try to be denominated in a way that you can meet your expenses, and maybe spend a little less time kind of trying to be a pig and go after like very high returns. In terms of people who are in crypto, I think we have seen a huge dip. It is a long-term buying opportunity. I would say it's kind of hard to know exactly what to buy right now. It's not clear. Everything has an issue. Bitcoin has kind of lost its narrative, although I think it will refine it at some point. So it's still like one of the safest bets in crypto is like, buying a $21,000 Bitcoin, in my eyes is never really going to be a bad thing in the long run. In terms of, alternative layer ones, we're seeing a lot of new ones come aboard. So it's not clear to me that, just kind of purchasing Solana and Luna Classic or the new one or even Avalanche is a clear trade. And of course, like the very interesting one right now is Ethereum, because that's gotten a boost from the date, the September 15th date being finally set in stone or in sand at least, and getting a lot of attention. So, some allocation to Ethereum, I think, can also do quite well long term. But I have recently dug quite deep into the Ethereum merge, and even that one doesn't fully leave me convinced.
Well, let's talk about that, because there's probably some people listening saying, what the hell are you talking about? This is the one opportunity in crypto that makes sense to trade. And I'm kind of on that camp. I go back and forth of I like ETH and Bitcoin both long term at these prices, but I kind of also view like I am excited as well for ETH short term. So let's talk about this. You said you were going to publish a piece. You tweeted you tweeted out. First thing I did, I said, let me see that. Let me see the first copy. I read through, and there were some things that I know people are going to disagree with. Like the findings that you had, it is not what I've heard. It's not what I think most people expect. There's these expectations and narratives that people have come to believe about what's about to happen. Is it healthy how people are positioned before we actually dive into each narrative? Do you think it's just been traders piling in? Or is it long-term investors? Like, how do you view ETH trading right now? We saw a slight run up, now a sell-off. How do you view this thing?
I mean, I kind of view it in a balanced and moderate way. If you realize that they had announced the date, you still have plenty of time to buy it at a low price, because obviously, the merge is a bullish catalyst in general. Like when you consider it to not happening, in terms of the price itself, it is bullish, but you can also exceed that bullishness and get too far. And that's something that we've seen time and time again in crypto, right? Like, Bitcoin ETFs and Coinbase ICOs and all these kind of events, they usually overshoot. And then we have like a very long correction period. So I think people who are expecting like just a clean move, but it's just up only and just supply diminishes and there's nothing stopping 10K from happening. I think they're going to be very disappointed, especially like with the macro environment that we talked about. And then, in terms of the piece itself, there are things that are factual that I've kind of dug up, and then there are things that maybe can be argued. Although I think that there is quite a strong argument to be made both ways, not just in the positive way.
It's like one of the first lessons I learned. First job out of school, I was working at an FX shop here in San Francisco. I was taking calls from people. It was kind of like a glorified sales role, but we talked a lot about the trading platform. And what would happen was I would get no calls most of the time, but around trading events, around catalysts, like we have for the merge, but this was FX, very similar. I would get just insane amounts of calls, like calls all day for multiple days. If it was around central bank rate decisions, if it was around non-farm payrolls, whatever it was. If there was macro data, I would get phone calls. And it wasn't people asking about the trading platform. It was people upset because they didn't understand how spreads could widen, how something could rip up, stop them out, and then dump. They thought, it was rigged, right? They think it's a scam around these big events. And one of the most important lessons I learned there was it isn't so much about whether or not the event was bullish or bearish, whether it was positive or negative. It was, what is the market's perception of what is going to happen in that event? People expect something to be uber bullish. This is going to change everything, it has to go up, and then it comes out and it's just slightly positive. It would sell off. And I realized, that seems like such a simple lesson for people. It's burned into my mind, but there were so many calls you get there. That was, how did this happen? Your trading platform isn't showing the correct price. How could this happen? How did I get stopped? And it just made me think when I saw your article, I was like, wow, I wonder how many people are thinking X about this merge when maybe in reality it's closer to Y. Like they're still kind of on the same axis, but it's vastly different from what people expect. So let's dive in here, because I think there's some big differences on what people expect versus what could happen. The first thing you talked about, the first belief people have is around reflexivity with the ETH price. What's the narrative here?
Arthur Hayes has been very popular as a blogger in crypto. He's very widely read, and he's one of these people who have kind of pushed this narrative specifically around reflexivity. This is kind of like a Soros narrative where expectations leads to higher prices, which leads to more attention, which leads to higher prices, and kind of like starts this endless cycle. I have two problems with it. One is short-term and one is long-term. The short-term problem is quite clear. Like as we've talked about, if everyone's positioned already one way going into an event, the downside is huge, and the upside, there's no one really left to buy because they've already bought quite a lot. So in terms of an immediate sell-off in a period of consolidation, I think that the idea of reflexivity obviously will be challenged. And the thing that he focuses mainly, which is the long-term reflexivity, he sees it as income being generated through gas burning. And he says that the more attention goes on Ethereum, the more developers will come, the more users will come, there'll be more apps, and then more gas will be burned, and that will create more deflation, and it just kind of creates a spiral. And I think that's kind of the wet dream that a lot of Ethereum kind of community members have. The problem with it is it's not quite as straightforward as more price, more attention, more gas. What really leads to more users and more gas is applications that are on main chain that have a lot of people wanting to use them and be willing to buy a lot of block space to use them. And that's not necessarily the same as speculation and price kind of attention. So even in the long run, I think there's a lot to be reconfigured in that reflexivity idea.
Even if people are buying, though, they're buying because they think this merge creates the opportunity for that later on. I see what you're saying. Just because the dynamics are changing here, just because the supply demand is changing here, doesn't necessarily, you can't just magically say that users are going to step in and we're going to have these apps that have millions of users. That still has to take place in order to then make this catalyst so important.
Yeah, there's really two distinct reasons why people are bullish ETH, and I actually find them quite contradictory with one another. So one really has to do with gas burning, blockchain usage itself, and the scarcity of Ethereum block space, which is the most secure chain for smart contracts. So that's very much a traditional company analysis where you look at revenues and you put some multiple on them. And this is kind of a cash flow analysis, right? Then on the other hand, you have completely different idea, which is, this is ultrasound money. This is a monetary instrument, a store of value. And to me, that really doesn't have much to do with block space usage or anything else. It's just people holding their ETH because they view it as like a long-term store of value that will kind of price appreciate. And these two things, not only are they separate, but I think they in many ways, as I've kind of written out into the article, clash with each other quite a lot. Because on the one hand, you have token holders who want as much gas to be burned as possible, and then you have users. And the users, they want like a good user experience. They want to just be able to buy their NFTs. They want to be able to do their financial transactions, to do the governance, and they want to be able to pay a reasonable amount and get their transactions through pretty easily and not get front run. Like they want to have good user experience. And actually, like these two are kind of in conflict with each other, as I've laid out.
The idea here is then, even if people are super bullish into the merge, it is kind of game changing. The reflexivity dies out pretty quick if it's just speculation based. So this is more likely to be a sell the news event than people think of, like a self reaffirming, I'm buying because the price is going up, things have changed and now price goes higher. I remember, like, if I'm looking back at super reflexive assets and moves that have happened in crypto, it's usually during alt seasons where there's this kick the can down the road. Oh, this massive change is coming to an altcoin. This roadmap is incredible, but the event never happens. So the belief is always there that things are going to get better and better and better. With the merge, we're going to have a catalyst. It happens. There's not really like another thing that kind of keeps the belief going. It's just, hey guys, price stop going up. What the hell's happening?
Yeah, I mean, once the merge is in the rearview mirror, and we know how forward-looking markets are, they're always looking at the next thing. This is true for equities. This is true for crypto. Once you have this like amazing catalyst, it's already gone. People will then hope that some of the other ideas that they had, such as internet bonds, or some of these deflationary cycles, pick up. But I don't think they will pick up given the numbers, what I've looked at, and the usage currently on chain. So I think you kind of dry out and you really need to create new user experiences that are very positive, or you need to just become a cult and view like ETH as like a new money kind of within a cult. And I'm not saying that like negatively. Like ultimately, cults have done really well in crypto as well. Like like a lot of these vaporware coins do incredibly well, and they don't really like offer anything apart from the community and the belief that like this is a good asset.
Before we move on here, I have to bring this up because we talked about Hex, one of the most famous cults in crypto. We talked a little bit negatively, I think, to put it nicely, about Hex. Did you get any hate? The price has dropped like 50%. Was there any Hex army attacking you?
Yeah, as usual, but I think there's going to be more. So like in a week, I'm due to be on a live panel with Richard Hart.
No way.
And it's gonna be interesting.
So he's doing it. He's talking with you. I didn't expect him to ever do it.
We'll see. It'll be a bit of a shit show. I'm not going to pull any punches, and I'm sure he never does. So we'll see what happens. I'm sure I'll get a lot more interesting comments after that specific show.
That is going to be fireworks. All right. Narrative number 2 for ETH, that the triple-halvening, which is going to be the merge, turns into this deflationary supply crisis. What's the belief here, and is this one closer to the truth or further than the previous narrative?
This one is a little bit closer. There are points to be made here. So just being very objective about it, in terms of buy the rumor, sell the news, the one time that doesn't really work is something like a Bitcoin halvening, because it does fundamentally change the supply. So we do actually see like halvenings end up being bullish even after they happen. And in this case, we are getting something very similar and even a little bit more pronounced, because the emissions are going to reduce quite a lot. So the inflationary yield that's sort of produced every year will go from being like, in my estimate, around from 4.5% to around 0.5 to 0.8%, somewhere in that region. So something of that nature will be quite bullish for the price. And I have done an estimate of what the pre and post price impact of that should be. And it is significant. Like, you are reducing proof of work rewards, which are much higher, 13,000 ETH a day, into something that's going to be closer to initially just 2,000 ETH a day, until more validators come online, and eventually it will kind of max out at 5,000 to 6,000. But even just that change, from 13,000 to say 3,000 is very sizable. And if you kind of give it a long-term view of where you would be now versus where you would be in continuing under proof of work, it does seem to my calculation that ETH should be worth about twice as much, which is a large amount. Obviously, we have seen a 100% move off the lows, but there is a case to be made that it's not fully priced in based on how powerful that indeed is. So, I'm not like an ETH bear or anything. Like I do give credit where credit is due. And in terms of price action specifically, it's a whole different story getting into like if proof of stake will kind of be as censorship resistant or not. But in terms of price itself, that change in supply is clearly very bullish and should theoretically double the value of ETH.
And does this take place immediately, or is it as we move forward in time, it's going to become even more impactful? I remember the narrative around EIP 1559, people were immediately saying, this makes ETH deflationary. And if I remember correctly, it was based on the usage, it was like we were trending towards that. And then I don't know if we are anymore. Like, are we immediately going to see this impact, or is this one of those things where it compounds over time of less selling pressure every single day, and as time goes on, makes it more deflationary? Like, how does this actually play out?
Well, in terms of implementation, it will be immediate. It will be implemented immediately. But it's the same as the Bitcoin halvening. Like the effect of having less supply kind of grows over time versus the two scenarios. So, it's kind of both depending on which way you look at it. But the supply will decrease immediately. It's not going to take a while to start decreasing. However, it's important to note that the triple halvening thesis has three parts to it. So one, is legitimate. There is actually a very sizable decrease in emissions. There are two other ones, and I would say one is kind of mediocre and one is really lacking. So the mediocre one is in terms of the burn, the idea that we will get into like a deflationary place because of EIP 1559. That's already been around a year. So we've seen the effects of it. This is not something to start pricing in because this has already been around. It's already priced in. The market already understands it quite well. And I make the case that it might even be overpriced in because in recent months, we've seen a very, very steep drop off in gas paid and gas burned by extension. So while in the past, we used to have, periods of waiting weeks and weeks to get a transaction under, maybe 60 GUI, and you would just be like so happy that you finally got your cheap transfer in after like weeks of waiting. Last night during Asian hours, gas was 1 or 2. Like it's really come down a lot. I don't think people realize the extent to which it's come down in recent months. And sure, like we're in a bit of a bear market, but not really. Like ETH has doubled during that period, and still gas is sometimes extremely low. On average, it's around 10 to 11 GUI. So the amount of burn has drastically reduced. And I make the case in the piece, which I really recommend kind of going through the details of, why there are structural changes, why this is not necessarily going to reverse. And in fact, the kind of very high burning periods that we saw are the exception. They're not going to kind of cyclically come back. Like that was kind of like a one-off situation, first because of DeFi summer and then because of the NFT mania. But I kind of describe why going forward, we should not expect to get to that kind of gas burning level.
Partially because of layer twos?
Yeah, so partially definitely because of layer twos, partially because of NFTs and DeFi. Both of them are much better understood now. And so that there are no longer these like games of, paying a lot of gas, regardless of how much it is, just because you want to pass it on to a greater pool. People start to like be a little bit smarter and they know like where the value is and where it's not. So these kind of Ponzi games what we had in DeFi or like, some of these like PFP like mints that where people are going crazy or like, trying to just mint them really fast. Those things are really well understood now compared to previously. And so the amount of inefficient gas burning, like, because it really wasn't very inefficient, is no longer there. And I would make the point that even, something like NFTs, because they were so new, there were no like successful NFTs off of Ethereum. So they all just kind of kept minting on Ethereum because it was kind of considered that, it's like going to Harvard. Like you get the degree and you kind of show it around and you're like, I'm legit. Look, like I went to Harvard. Like look at my diploma, right? Like there was like a lot of value just in that piece of paper, but it's not clear that those projects really need, $100 billion of security. Like if you have a, $25 million art project, do you really need like all the security of Ethereum? Can you just mint it on Polygon? Can you mint it somewhere else? And as we start having a lot more examples of successful projects being on other chains like Solana or other chains, people start to see like, okay, maybe like I don't need to have a Harvard degree. I can just have a degree from Berkeley or from somewhere else. And that will also kind of give me credibility. So that kind of halo effect around needing to have an NFT on Ethereum is also kind of fading away. And I think that's quite a big deal.
To push back on that a little bit, though, from the ETH max perspective, but I think even from people just moderately bullish crypto, the idea that we won't have that many DeFi users and NFT users, sure, there's going to be code efficiency. We're going to get better. We're going to have procedural efficiency. People won't, as you said, be playing these gas games to mint NFTs. Also layer 2s, like that's all going to help. But at the same time, if you look at where we could be going if crypto wins, the amount of users using DeFi, the amount of people using NFTs, like we've barely scratched the surface, in my opinion, of what NFTs are going to do. The idea that that activity won't come back maybe tenfold or 100-fold, that's a little bit tougher for me to see.
No, I mean, we can see a burst in general. It just doesn't need to happen on the main chain. It doesn't need to involve like very high like gas transactions. You know, when you look at layer 2s, even if they want to stay within the Ethereum ecosystem, there's two ways that theoretically like ETH can get burned. One is, of course, like, you know, layer 2s need to transact on the main chain to kind of keep state. But that is not a huge gas cost. You know, that's also getting more efficient over time with kind of code efficiency that's being developed. So gas cost for just, you know, keeping a layer 2 check marked on layer 1 is not that high. And in terms of like the layer 2s themselves, initially they are burning gas in ETH. So if there happens to be a ton of ETH being burned on layer 2, that will of course be bullish as well. But it's not clear to me that in the long run, the very successful ones will either want to stay layer 2, or even if they want to stay a layer 2 and keep, you know, checkpointing onto like a Ethereum main chain, they might start deciding to burn their own token. So of course, we've seen some discussion on this already with Optimism on their forum. But as more chains have sticky users and they have their own token, it's kind of like what we see in Spain, for example. If you have Catalonia, and it's a little bit of a richer region than the rest of Spain. And of course, at some point, the locals want to separate and not pay taxes anymore. You know, it's kind of like the same sort of dynamic where if a layer 2 does become very rich and the locals are having a lot of activity, will they keep voting in a world where, you know, token value accrual is everything, which is crypto? Will they keep voting to remain as taxpayers into kind of like the ETH country? So that remains to be seen. You know, we'll see. But I strongly believe that incentives are usually, you know, going to win out in the end.
All right, last piece of this belief that going to be a massive change in supply dynamics is that the stake supply of ETH will be locked, and that lock creates this sink of this amount of ETH is just off the market, can't be sold, can't be traded. Is this one right or is this one wrong? How misguided is this staked theory?
Yeah, I think like the idea of kind of hiding tokens so that nobody can sell them is misguided in many ways. I mean, first of all, if somebody wants to really sell something, they can do it through derivatives, they can do it through other ways. They don't necessarily need to go get this like specific ETH that's being staked. But furthermore, as we talked about before, going from, you know, the next catalyst being a positive one, which is like a merge and a supply change, into like the next catalyst being the Shanghai fork, which, you know, could happen 6 to 9 months after the merge. But people will already start looking at it as it gets closer and closer, and they'll be wondering, like, is this gonna start kind of creating a dump of ETH? Because you've had people that have been staking for a long time. They've been accumulating rewards. They haven't been able to sell those rewards. Like proof of work rewards have been sold every day, but the proof of stake rewards have kind of been locked up until like this hard fork will happen in 6 to 9 months. So I don't view this at all as bullish. I view this as kind of like creating an overhang that will just stay over the market for like the next several months, especially during like what will be like a difficult price period, and create doubt that, you know, there could be like this unwind that happens when people are able to finally start unstaking. And people counteract and say that, you know, there's going to be a queue. You can't just, not everyone's going to be allowed out at the same time. But I don't see that as being positive at all. Like if you start seeing that there's a queue of people wanting to get out, that's where you really start panicking and just start selling derivatives. So I'm not convinced at all by the idea of, you know, locking up supply.
And also I'm thinking about the queue. If you start to see people in front of you in the queue, they're insta dumping. Immediately when it's your turn, you're going to sell as well. It creates a weird like rush for the exits. It forces almost a rush for the exits by queuing.
Exactly. Yeah, I think psychologically that kind of being on the horizon is not very positive.
Third narrative that a lot of people believe, staked ETH will become a yield seeker's sensation. And this one was the one right after I read it. I texted you and said, Jordy, we got to talk about this, because I've had guests on the show and I've asked them, and maybe their numbers were actually good back then. I don't want to dog anyone who's had projections. Things do change. But the numbers that I saw 6 months ago or 9 months ago, whenever it was, when they were projecting out how much yield could you earn by staking your ETH, were much higher. Like by a magnitude, I think it was 5x or almost 10x higher than some of the numbers that you're projecting here. Let's walk through how much money people are actually going to be able to make staking their ETH, because this is a big belief that you're going to stake your ETH. It's passive income. Further reiterates why you hold your ETH. I think this is probably one of the biggest narratives. What's the difference here in terms of what people believe and what's actually going to happen?
Yeah, I mean, absolutely. There's a huge disconnect here. And out of everything that I studied and everything that I researched for this piece, this is by far the item that surprised me the most and really kind of didn't make me bearish, but kind of pushed me like very far away from being kind of ultra bullish, because I know that there will be a reckoning for, the expectation that we will have this productive asset of staked ETH that you can also do DeFi with, and it will also be generating like a very high yield, and it will be like an internet bond, and it kind of sounds like a fantastic version of internet money in a way. So it sounds too good to be true. And that's kind of easy to say, because there should not normally be a free lunch, right? Like when it comes down to it, having somebody who's not doing any work and has no extra information and is simply buying ETH and staking it, and maybe not even running their own validator, they're just buying STETH or one of these other kind of liquid tokens. The idea that will kind of generate outsized returns, and that is a state that can sustain itself, is immediately kind of going against like a lot of the laws of economics. So I kind of started digging in, trying to understand like where does this go wrong? And I found like several places it goes wrong. And that's why when they start accumulating with each other, the difference in yields, and especially real yields, which is kind of after inflation, start to diverge so much from reality. And I would say it's been a little bit disappointing seeing like even the official kind of Ethereum Foundation projections and a lot of the researchers that are kind of considered the authorities, and really a lot of people follow them without doing the work themselves, and they just kind of they assume that the Ethereum Foundation or Masari or like these kind of very well established players really understand the numbers. They've been way off, so we can kind of look through like all the pieces.
Yeah, let's walk through what's the Ethereum Foundation, those official numbers projecting, and no hate towards them, but I'm curious. I just haven't seen those figures.
I mean, they are a bit stale. And when I say the Ethereum Foundation, it's mainly Justin Drake who's very outspoken about these things. It's a bit worrying. I have gone through some of his other predictions. For example, he said with 95% confidence interval, this was just back in April. He said with 95% confidence, the ETH supply will never exceed, Vitalik's magic number, which was 2x the initial, Genesis supply, and that comes out to like 120 million, 0.221. So as this episode gets out, people can probably go to Etherscan or just CoinGecko and look at the supply, which is never supposed to exceed this number. Within like a day or two from this getting released, it will exceed that number.
Oh no!
So like these like huge predictions are kind of based on what we talked about initially, like the assumption that gas burning is going to be what it was during the DeFi summer and the NFT mania, which is clearly not. So the idea of having a deflationary currency and ultrasound, it's a great meme, but it's not going to be deflationary. The projections were wrong. Like gas has come off so much, and it doesn't seem to have like a way to recover, that the projections of 25% yield are just so off. I've had a few people kind of challenge me on Twitter, telling me that my numbers are wrong. But as soon as I try to offer like $1 million bet or something, they immediately back off, or they want to make it so that it's just like a one-day yield, like on the merge day itself. Which I've been very explicit on the merge day, there could be a huge amount of like MEV and gas bidding. Like it will just be, especially if there's a fork that is valuable and it kind of reprices things. you can have a huge amount of activity on that one day. So like let's forget like, that immediate kind of few days period after the merge. I agree that there will be a lot of gas burning that happens there. But let's just look, a few months down the road, right?
What is that number? If people are projecting 25%, because that's close to what a previous guest I had on the show said. I think they said around 15 to 20% is what, and I imagine, as you said, these are highly followed people. This is what the market's expectation is that people are going to make. They're going to have this ETH. They're bullish on ETH price. Why not stake it, earn some yield, especially if that yields 20%? All of a sudden you start to think this thing is going to go to the fucking moon. If everyone can hold this, earn 20%, why would I ever sell? So if that number's, just a tiny bit different, maybe not so much of an impact. If it's like 98% lower, then you start to get a little bit worried. What are the numbers you came out with? Because I think it's close to that.
Yeah, it's very different. So there's two periods. One is the period in which you're taking on risk. You're taking on merge risk. Like if you stake right now, you are taking on the risk that something goes wrong. With the tech, you're also taking on illiquidity premium because you won't be able to get your money out for, let's say, 9 months on average after the merge happens. So you're really locking up your equity for 10 months or so. So if you're willing to pay those risks, then you can get a little bit of yield now. Like you can get like maybe 5-6%, which is still like way below. The scary part is, what if you want to get yield that is post-merge, like, after the risk and maybe kind of closer to providing a liquidity event? That's where things get very messy. First of all, there will be a queue immediately. Like if there's a successful merge, people can't just stake. There's only a limited number of validators. So only about like 2 million ETH a month will be allowed in. So there will be a queue. You can immediately like buy a liquid staking protocol like Lido. The problem is you will be diluting the yield for everybody else because Lido itself will not be able to stake your ETH. They will also have to wait in queue and they will just dilute everybody. So even like the liquid staking yield, which you can immediately get, will be like very like diluted. Otherwise, if you're trying to do it yourself, you will have to wait in queue for several months. At some point you get in, and at that point, a lot more people will be in. And what people don't realize is the reason why, 25% and 15% and 10% and whatever else is not reasonable is there will be more validators than there have been previously. And we're already seeing like kind of 1 million a month being added in terms of ETH. And each time there's 1 million or 2 million being added, which keeps happening every single month. Remember, it's locked up, so nobody can take out. It's the number is only going up. So as this keeps going up, the yield from block subsidies is lower. It kind of gets diluted by like the number of people who are in. And also the MEV and the gas tips, that is proportionally getting lower because that is distributed across everyone who's validating. So just having, a lot of the projections were made when they looked at how much ETH was being staked, and it was maybe like 5 million or even up to 10 million. Now it's kind of around 14 million, and within a few months it will get to 20 million. So once you're at those kind of numbers, everything falls by like half or so. And that's assuming that you have the kind of gas tips that we've had historically, which you definitely do not. When you start aggregating all these like wrong assumptions, they really start to add up and the numbers get quite flimsy. So let's say I'm somebody who wants to wait for the merge to happen. I don't want merge risk. The day after, I'm going to get 32 ETH and I'm going to get a validator and I'm going to wait in queue. I estimate that, by the time you get in and for any like substantial amount of time that you want to wait after, your yield like for the first year will kind of be maybe 3 to 4%. And some of that will be inflation because inflation will go up as well as more people are having to get paid. So your real yield, as we get towards kind of like the fork and you stop paying the illiquidity premium, really starts being around 2% or 1 to 2% in the long run.
And does that go down then even after that 1 year? Like the amount of ETH staked is going to keep increasing.
We should consider other chains like Solana. Every other chain has been proof of stake already. There's very few chains that are proof of work. And we can see on other chains that are proof of stake what percentage of the stake is being done. And it's over 50% in all cases, sometimes up to 80, 85%. Like if you look at Solana and some of these other ones, it's a very high percentage staked. Now, we're not going to get there immediately because, like I said, there's a queue. So it will take a while to get there. And also, possibly because ETH is more distributed and less centrally held, it might not ever get to like 80%. It might just get to 50%. But even 50% just completely changes the numbers that are given out. Like right now we're at 10% or so. Getting to 50% will kind of create a real yield that is extremely low. Like I said, around 1% to 2%.
That's a bit of a wake up call to what the numbers I was seeing. I mean, I started having visions of I should have known this because I fell for the masternode, the Dash, whatever that whole theme was back in 2017, 2018. I remember I bought a bunch of Zcoin, and it was this idea that if my Zcoin node is worth X amount, it's going to earn 20% forever. Dash masternode saw this happen where a Dash masternode was like $1 million and it was earning like 100K or 200K. And then eventually everyone realized, holy shit, this can't go on forever. What are we all doing? And then obviously price collapsed. I don't think it'll be as severe here, but as you said, it's if the expectation is something here and it's 98% lower, I mean, that is a massive difference. This is one of those narratives that I think had the biggest mispricing, and I'm very curious how people are going to react when they hear this.
Yeah, I mean, I hate to be the bearer of bad news. Like, I'm not bearish ETH in general, and I have ETH, so I'm not trying to fund the price, and I don't want to get kind of hate mail for
Right.
being anti-ETH or something. I think it's more healthy if we have our eyes open and
100%.
we go into this knowing what's going to happen, rather than having a big crash later on once people kind of start realizing that actually this 5% or plus is really not going to happen. So I am very confident on these projections. I will say that the people who've kind of publicly tried to challenge me on these numbers have generally backed off once they've seen like the kind of more up-to-date calculations. And the internet bond narrative, it's a good idea for people to stake because it increases the security of the network. But they need to understand that as more people do that, there's a huge dilution waiting, and there is no free lunch, unfortunately.
Yeah, as you said, I think it's very similar to the episode I just did with Kevin, where it got some hate. And even halfway through the episode, we were talking about some of the assumptions he made and ideas he's presented. And it was funny. We were looking at how people doing that trade where they're buying spot ETH and then shorting futures, it'll already, in some ways you could argue, is already helping ETH, the ETH2, proof of stake. The amount of hate he's getting, I was like, dude, some of these ideas that people are hating you for are actually already helping ETH because people are realizing the situation they're in. Like, you can't just close your eyes to bad news and say, man, we shouldn't have talked about that. It wouldn't have affected price. It's like, no, it's good if we start to adjust our expectations. Then it's not this big shock that kind of shocks the market and never does to sell. So I appreciate the numbers, and I'm very curious if anyone takes you up on that $1 million bet. Taking all three of these beliefs into account, some with varying degrees of truth to them, and some with a little bit further from that, there's kind of a combination of all of them, which is that ETH is going to be the one true chain to rule them all and take over. You've done a very good job of breaking apart which one's closer to the truth, further from the truth, tying them all together with ETH now being the chain that really takes over and continues to eat market share. How does this fall in? It combines them all.
Yeah, I mean, this one is a little bit more, it takes judgment to kind of look through this one. It's not clear. It's going to be like different opinions. And as you know, people have very strong opinions on, for example, the monetary side. Like, is Bitcoin better or is Ethereum better as a monetary instrument? Like, people are very divisive on this. So it's less clear. But what I wanted to point out in this section is that the idea that like Ethereum will be able to do all the use cases and be all of the above is not necessarily without conflict. Like, there are a lot of inconsistencies within these narratives that start to like work against each other. And as like proof of stake happens, and as we move closer to, the vision of Ethereum, we start to see that there are different user bases and different power bases and different descriptions of what people think Ethereum is and is not. So this is also extremely relevant with what we've seen recently with, Tornado Cash, and what people think is the way forward after seeing, the US government intervene in such an unexpected way. So going through like the ways that there might potentially be clashes between Ethereum being able to do all of the above. We start with, for example, the lunar punk versus solar punk kind of idea, where there's a chain that is, KYC'd and friendly and like a very Disney kind of chain where the US government is fine with it existing, and actual corporations and institutions are able to transact on it. and that can potentially be like a very valuable large chain, right? Like that might be where token holders want to take the direction, because that's that will ultimately benefit the price. So token holders might want to go that direction, which is like a solar punk direction. But then the people who have created this technology, and a lot of developers who are very idealistic and really believe in like the ethos of, censorship resistance and like not being able to be KYC'd and being able to have privacy, they will probably want things to go in the sort of like lunar punk direction, where they're really creating an ecosystem that is maybe like less widely adopted, but serves a purpose, and like in a very important purpose, right? So a lot of us in crypto believe that it is very important to have this like alternative layer that doesn't necessarily play nice with the powers that be. So, that conflict will only accelerate post merge, and especially as we see like this idea of token accrual and gas fees being burnt, that will start becoming evident in many ways. So not only like the ways that we've described already, but even like a user experience way. If a user is paying less gas, that's good for the user, but it's bad for the token holders. Like they want gas to be high, like as we've discussed previously. So as you get apps that are making things very efficient, that's only good for users. That's not good for Ethereum as kind of like a revenue source, right? And it is very likely to happen. Like we saw that with Coinbase back in the day. A lot of us bought our first crypto on Coinbase, maybe, and they were charging us like 2% or something, completely insane. And they got away with it for a very long time. But over time, more efficiency kicked in, and now like you're not really paying more than 10 bips and for your transactions, and that's a huge change to the bottom line. And as we've seen, like Coinbase's revenues have come down a lot. Even though it's better for the users, it's probably like worse for their balance sheet, right?
And so do you think that based on that constant struggle between users and token holders wanting to accrue value, like how does that war only gets worse? I kind of view it like the NFT example you gave, where I do think that ETH will win most use cases, but I think there's also fringe use cases and things like NFTs where maybe we don't need as much decentralization. Maybe people are kind of okay with just it being on a database, especially if it's coming from a company anyways. Like I see both sides, but I kind of lean towards,
Yeah, there are two sides to it. Like I think it depends, like do you take the direction of, you have a blockchain, there's block space on it, and how do we make this the raddest, coolest, place where everybody wants to do all their stuff? And then you start that's the Ethereum ethos, and you start wanting to have everything, and you want to like be money, and you want to like be bond, and you want to have a great user experience, and you want to be censorship proof, but you also want the price to go up. And then, the other way to look at it is kind of a bit more how I look at it. We only care about users, right? Like ultimately, the Ethereum only is as important as the usage that it gets, and the block space, how it gets used. So I look at it from the app perspective and the users of those apps and the use cases, and I go from there backwards, and I say, what are the use cases? Why are people wanting this technology? Like it's not clear to a lot of Web 2 people that there is even any space for this technology. But let's kind of go through like use cases. So decentralized money. That's kind of like the Bitcoin use case, and you can kind of think about, what's the right chain for that, and then you kind of look at decentralized finance, like financial applications. Okay, then you look at entertainment, games, you look at governance, you look at all kinds of like use cases, even things that a lot of crypto people scoff at, like something like StepN, for example, which I actually like view as quite a good example of what can be done with crypto. Like you have a lifestyle app. Like I'm quite big on the idea of lifestyle apps, actually. Like they integrate into your life and they create incentives for you to improve yourself or act or be healthy or eat a certain way or move a certain way. So, I think there's a lot of use cases there. But then you start looking at them individually and you say, what is the right chain for this use case? Like, what does that look like? So it's a completely different direction from which to approach things in. And when you go from that direction, you start to look at things different, and you say, well, each use case, especially if it's a large use case and it doesn't need to like share $200 billion of security, which is really what Ethereum provides, can make its own decisions in terms of like the where does it want to be on the spectrum of cost versus security, and how much does it want to have independence. So like, for example, DYDX kind of decided they're going to go on their own app chain. rather than be on a layer 2, so they can like fully design it and spec it exactly like how they want to do it. And exchanges are a use case, like decentralized exchanges are a use case, and we're seeing that maybe they want to just have their independence. They don't want to be on Ethereum. And obviously, like Bitcoin maxis will of course talk about how Bitcoin is just a bullet versus Ethereum is like an octopus, and it can do all kinds of things. But sometimes you just want a bullet, and it's just simple. And you kind of go through, and it's a different perspective. And what I wanted to note was as we get through like the merge and forward onto like more and more forks as we go forward, a lot of the kind of hardening of decisions starts to influence direction. And right now, pre-merge, Ethereum can be everything. It can be lunar punk, it can be solar punk. But like as you start to make decisions that influence, where does the censorship resistance end up being, and like where what's the user experience, and you have to start making decisions as you go forward in the roadmap.
Yep.
It's not clear that you can be everything to all people.
That one is harder to push back on, I think. But the first three they're going to get, there's going to be so much discussion about this, both in the article, both on this episode. For anyone listening, if you have questions, thoughts, feedback, please tweet at me, tweet at Jordy. Be civil. I know that you guys won't. That's just Twitter. But I'm looking forward to seeing if anyone takes your bet on some of these. This is it's going to be wild to watch, man. It's definitely changed my idea of, rewind 6 months, wildly bullish on the merge. After talking to you and Kevin, some of those ideas have definitely been challenged. Like I'm still bullish, still obviously think long-term ETH and Bitcoin are good buys here, but I do look at the merge as much less of, I should be uber bull here. I don't care what people are saying. I don't want to get faked out by, kind of doubting. I do think there's definitely some causes for concern. I think this is going to be valuable. I think it also, as you said, helps the market.
Absolutely. And like I said, I'm long ETH, like I have ETH.
Yeah.
I want
too.
ETH to do well.
Me too.
And I think like the way that long-term it does well is it does look at, what is it designed for? What are the use cases it's designed for? Focusing on those and less about like fake narratives. And, maybe like the best use case is as a monetary instrument. Maybe that's the case. And then it needs to start kind of making decisions around that. Like, I think just deciding on a direction that is coherent and is also truthful and doesn't kind of give numbers that are, and then end up being outside this 95% confidence interval is just much healthier for an ecosystem.
Completely agree. One of the funny things about this is everyone's been hating on macro, myself included. It's one of those things where it's just frustrating. Like when there's an event like this, you look at Bitcoin, you see ETH at 3-year highs versus Bitcoin, you say, man, if we were just bullish, if macro could just sort itself out, we'd be so much higher. I guess the silver lining is because macro is holding some of this stuff back, I think it's actually protecting us from having an event where we just run up ridiculously high on ETH, everyone gets uber bullish, and then we have massive selling pressure because we realize, why the fuck were we so bullish? We didn't have all this stuff figured out. I think macro is actually helping us here, having some of this stuff controlled. It's kind of a unique realization I'm having. That
safer, like how amazing would it be if we just have like an asset that can give us 10-20% returns for the next several years in like a pretty reasonable volatility, rather than have something that goes up 3x and then goes down 3x, and you have to time it right, and you can't just hold it, and you don't know what's going on, right? And get liquidations you never imagined, like we've had.
To wrap this up here, and to maybe give a slightly bullish take, because I know you're long ETH, I'm long ETH as well. We're not here to bash ETH. I just think it's good to be critical about some of the beliefs. One of the things you tweeted in the past was this chart. It was this Venn diagram that looked at crypto cycles and how when altcoins move versus Bitcoin, whether that's good. And for people listening, just so they can kind of understand what we're about to talk about, you had this chart where it was participant 1, participant 2, and it was if they both pump Bitcoin, that's good, right? Bitcoin goes up, some altcoins go up. This is good for everyone. If one guy pumps an altcoin, one guy buys Bitcoin, that's still pretty good. Maybe the altcoin goes up a ton, maybe Bitcoin only goes up a little bit. And you walk through all of these down to the bottom one, which is if everyone is just pumping the altcoins, it's not going to go well because Bitcoin will go down. Eventually that brings everything down. The reason I'm bringing that chart up is because we're in the scenario where ETH is kind of the only thing in crypto that people are excited about or talking about, right? The narrative is a little bit died for Bitcoin. Most other altcoins don't have a narrative. It's not risk on. There's not new retail money. But ETH has this merge coming up, right? In 2 weeks. if everyone tries to pump ETH, is there a scenario where ETH can actually do well if Bitcoin's not going up? I think as we talked about, it's like macro's kind of keeping us in check. Or is there any way that ETH can actually break out of this and we do just see ridiculous price appreciation? We see the flippening happen in the next year or two? Or do you think that's always going to be a bad end when we have everyone just trying to pump ETH and Bitcoin still isn't moving?
I mean, you always need external people to come in and keep pushing up once the insiders, are tapped out, like they're all in. You're always going to need a lot of other kind of retail or not previously participating people to join in. In this environment, we don't have stimulus checks going out. Like, people are having a hard time with their bills, which is why, like you said, I think the macro environment will kind of keep things in check. And so we kind of need to maybe keep ourselves in check as well.
All right, Jordy, appreciate you coming on to walk through this, dude. A lot of people have questions right now, maybe people too optimistic, and I hope this episode helps keep them in check. I think that will result in a better outcome for everyone. Jordy Alexander, thank you, man.
Thank you.